Hi, David. Thanks for joining me.
Hi, Susie. It's great to be with you again.
Well, the tax bill signed in the summer of 2025 made some big changes to the estate tax laws. Let's start with, at a high level, what do clients need to know?
You're right. There were big changes to estate tax laws last year. Before last summer, the estate and gift tax exemption, meaning the lifetime amount you can pass to beneficiaries, estate and gift tax free, was scheduled to drop from about $14 million per individual to an inflation adjusted amount of about $7 million. Now the federal estate and gift tax exemption is $15 million, and it will continue to grow even higher as it's indexed for inflation. Note, however, that while these amounts were made permanent, this only means that there is no built-in end date. It's possible that future legislation could reduce the federal exemption. It's also important to keep in mind that the new laws only apply to federal exemptions. Some states have different, often lower, lifetime exemption amounts.
All right, so you've got a large federal lifetime exemption, but there's also an annual gift tax exclusion. Many of us find this confusing. So how do the annual exclusion and lifetime exemption work together?
Yeah, this can be confusing for clients. In addition to that $15 million lifetime exemption, there is a federal annual gift tax exclusion. This year, it's $19,000 per person per recipient. This means that in 2026, you can give away $19,000 to anyone or to any number of different people without using any of your lifetime exemption. Now, here's how that might work in practice. Let's say you gave $100,000 this year to a single beneficiary, such as your child. You'll need to file a gift tax return, and then the amount above the annual exclusion, in this case, $81,000, would count against your lifetime federal exemption. So in this hypothetical scenario, you would have $14,919,000 remaining of your federal lifetime exemption. If you're concerned about federal estate taxes, annual gifting can be an important strategy because by making regular annual exclusion gifts over time, you can get quite a large amount of money out of your estate without using any of your lifetime exemption. So continuing with the example I just used, let's say that you were giving away $100,000 this year, but you split it amongst 6 beneficiaries. Since each one would receive less than $19,000, none of those gifts would count against your lifetime exemption. Now, married couples can also combine their gifts to give $38,000 per beneficiary. Note that for a married couple to split gifts, meaning treat gifts in a given year as made by both spouses, taking advantage of both spouses' annual exclusion, these spouses would need to file gift tax returns known as a Form 709.
All right, well, that's a really clear explanation of what happens with federal estate taxes. So if you know your estate is going to be below $15 million, do you still have to think about estate taxes?
Yes. Even if you think your estate will be below that $15 million threshold, there are important reasons to plan. As I mentioned earlier, laws can change. You also need to account for the potential growth of your assets over the long term. And clients are sometimes surprised to find that certain assets are included in their estate. For example, life insurance proceeds and retirement assets count as part of your estate for estate tax planning purposes. Another important consideration, as I hinted at earlier, is state, estate, and inheritance taxes. At the moment, there are a number of states with some kind of death tax. 12 states and the District of Columbia have state estate taxes, and 6 states have a state inheritance tax, which is paid by beneficiaries on the assets that they receive. Maryland has both a state estate tax and a state inheritance tax. Connecticut also has gift tax on assets gifted during your lifetime above the annual exclusion. And state death tax thresholds are typically much lower than the federal exemption. For example, in Massachusetts, where we're at, it's $2 million. Finally, it's even possible that your estate could be exposed to death tax in another country. For instance, if you are a citizen of another country or have assets located outside of the United States. An estate planning attorney can confirm whether you have state death tax exposure. They can also evaluate whether the annual gifting strategy I mentioned earlier would be effective for state estate tax purposes.
All right. Well, a lot of our clients know that trusts can be a way to help manage estate taxes. Are there benefits to a trust besides estate tax planning?
Yes, you may want to consider having a trust as part of your estate plan for a number of reasons besides taxes. One is the management structure of a trust. You could hire a professional to oversee the trust, and that trustee can also hire other professionals such as a financial advisor, an accountant, to make sure investment decisions and tax filings are handled properly. Trustees are also responsible for making trust distributions to beneficiaries, which can allow them to manage money for minor beneficiaries or help beneficiaries who might struggle with budgeting to use money more wisely. A trust can also be structured to provide beneficiaries with creditor protection in case a beneficiary gets sued or divorced. If you've been married more than once, you might want to consider a trust since it can allow you to provide for a surviving spouse during that spouse's life, then direct where any remaining trust assets go after the spouse has died. For example, to the children of your first marriage. Finally, if the trust is funded during your life, it can help your estate avoid the probate process and allow a trustee to manage your assets for if you're alive but unable to handle them yourself.
All right, well, if a client has determined that estate taxes aren't going to be an issue for them, do they still need to do formal wealth transfer planning?
Absolutely. We believe estate planning is important for everyone, no matter the size of your estate. If you don't do any estate planning, the state will do it for you, and it may not be what you intended. Additionally, understanding different beneficiaries' distributions around inherited IRAs can help you make income tax efficient choices on beneficiary designations. Similarly, having other documents in place like a durable power of attorney, a will, and trust can help ensure that if something happens to you, the people you want handling your assets will be able to do so according to your wishes. Your Fidelity representative can start a conversation around estate planning and help you assemble information needed for the process.
David, as always, we appreciate your help.
Thanks for having me.
If you have questions about estate planning, reach out to your Fidelity representative. If you don't have a Fidelity representative, visit fidelity.com/findinadvisor. And for more timely news and thinking from Fidelity's top thought leaders, subscribe to Insights from Fidelity Wealth Management. I'm Susie Allen. Join me again soon.